We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jesse Felder, founder, editor, and publisher of the FelderReport.com. Thanks for joining me today, Jesse.
Good to be with you, Tom. Thanks for having me back.
So, Jesse, you recently wrote an interesting article that really visualizes the effects of money printing that was started by Ben Bernanke and continued by all of his successors. So when we hear about the initial mechanism of money printing, that was supposed to be boosting stock prices. And as a byproduct, that was supposed to boost consumer wealth and lead to higher incomes and profits that, again, will lead to further economic expansion. So in essence, was this almost a trial for MMT and really its outcomes as well?
That's a good question. I don't know if Ben Bernanke had MMT on the brain when he proposed QE initially. What we do know is that he did write a piece for the Washington Post in, I think it was 2010, suggesting that money printing should boost asset prices, which should boost people's idea, create a wealth effect, make people feel wealthier so they go spend more, which boosts the economy, boosts incomes, and creates kind of a self-reinforcing upward, virtuous circle of economic growth leads to all these good things. It's clear that they did boost asset prices, right? You look at I think the best chart to view that is just household net worth to GDP. We've seen household assets, stocks, real estate, bonds, the value of these things have soared relative to the economy. But when you look at that household net worth, instead of comparing it to GDP, but compare it to M2, it's clear that it's all been an illusion, right? It's all been a money illusion. We printed enough money to boost the prices of those things relative to the economy, but relative to money printing, we've seen the value of household assets essentially flatline and actually decline a little bit. So the money printing hasn't really boosted real wealth when you measure it this way. And I think that's the best way to kind of measure these things. How much real wealth has been created, and that's wealth that grows in real terms, whether it's inflation adjusted, and I think M2 is probably the best way to measure that. Household wealth has actually declined, and the economy has really done very poorly compared to the money printing, and that's just a sign that the money printing hasn't boosted the economy in the way the Bernanke told us it would 13 years ago, and so. What has the Fed really been successful in achieving? Well, they've been successful at reviving inflation, right? That's the lesson of the last couple of years is they haven't boosted real household wealth. They haven't boosted the economy in any measurable way at all, but the money printing has led to a boost in inflation. And, that's something that you could have looked back at any economy in the history that resorted to money printing to try and solve its problems. It always ends up in inflation. And so, I linked to the article to a book, Peter Bernholtz's Monetary Regimes and Inflation. And it shows that throughout history, whenever you pursue this type of a monetary policy, it results in inflation. And so I think that's kind of the key lesson to take from this is that, money printing is really only good for one thing, and that's creating inflation.
Yeah, I think that's really well said. And, one of the most dramatic charts that you have in that article is the GDP divided by M2 that I have on the screen right now. And it's now lower than at the start of the program in 2008. And seemingly this is just a downward trajectory. So do you think that this would be, more of a better way of the average person understanding what we mean by inflation, or more clearly said, maybe the devaluation of their currency?
Well, yeah, because basically what I'm doing with these charts is deflating these things by some type of a deflator. And a lot of times people want to deflate them by using CPI, right? But CPI is kind of just a convoluted guess at what inflation really is. I think if you just look at the money supply, right? Money supply growth is probably the simplest, most straightforward measure of inflation in the economy, right? If your money supply is flat, right, it's very difficult to get inflation in the economy, in the real economy. And if your money supply is growing massively, like we've seen in the last, 3 years, you're going to get inflation. And so for me, it was just kind of a natural thing to say, okay, why don't we deflate these things by the growth in the money supply, and then measure the real growth in these things in that way? And probably there are real economists out there. I am no economist, but economists would look at it and say, well, you can't deflate by M2 because of X, Y, and Z. But I think for the common sense, layperson to go, well, I do want to see how much has my net worth changed relative to the amount of money in circulation. That's actually what matters to me. How much is my purchasing power held up with the overall value of the money in circulation? So I do think, looking at and seeing the fact that the money printing has not helped the economy at all. In fact, it's done just the opposite. It's boosted asset prices, boosted inflation, while the economy has stagnated, is kind of an important indictment of the monetary policy that we've seen for the past decade plus.
Mm-hmm. Yeah, it seems like a difficult idea to kind of wrap your head around what you end up using as a goalpost to really compare your wealth to, and what these policies have done to your wealth. And the ability to look at that over time, I think, would be really important for your average person to understand a little bit more about this. What are your thoughts on how or what you could use for a goalpost, or the measuring stick in which to make that point?
Yeah, I mean, it's a challenge, but I'll just say that if somebody says, I'm going to pay you not in US currency, I want you to do this job for me, and I'm going to pay you in money that I'm creating, and maybe it's a cryptocurrency, whatever. Mm-hmm. And that person says, okay, I'm going to pay you, there's 100 Jesse bucks in circulation, I'm going to pay you $50, so you're going to own half of all this money in circulation. Okay, great. Well, as soon as I go pay this person, I'm going to go print another 50 Jesse bucks. Well, then you're going to go, wait a second, I thought I owned 50% of what's in circulation. Now I only own a third of what's in circulation. You just devalued the money that you just paid me, and you debased it in a dramatic way. Mm-hmm. And so, I could, if I were to go pay people in my Jesse bucks, and just every time I needed to pay somebody, go print more money, all that money in circulation would be rapidly devalued to the point where, instead of getting paid what I thought $50, was of Jesse bucks, that was $5 or is 50 cents or whatever, depending on how much money printing there is. And so I think that's helpful to think about the way the economy is working. It's one thing, okay, my stock portfolio went up X amount, went up 10% last year, 20% last year. My bonds did X, my real estate did X. But if the money in circulation also went up by that same amount, I'm basically just staying flat. I have to go up 10% just to kind of go to meet the same the growth in the money supply. And I think that's probably a helpful way for people to think about things. If the money supply is growing rapidly, my purchasing power is declining rapidly, and so that's why I think it's helpful to kind of look at things in this framework.
The other side of that, I think, is, let's say, difficult but necessary to add in, is let's say the demand for all those Jesse bucks outside of the US. With other countries needing to settle trade in US dollars, and I mean, I think it's a separate discussion whether or not that trend is declining or not, but what effect does the rest of the world needing, more US dollars have on the value of the dollar? And do you think that the value of that currency to be able to trade in is the value and or the demand for dollars is waning?
Well, I think, there's two things to separate there. There's the stock and the flow, right? The flow would be, trading in dollars, and the stock would be, the dollar as a reserve asset, for central banks. And I think that the money printing, whatever, might not affect the flow of dollars at all. It might actually create more flow, more trade in dollars, because there's more dollars in circulation, all that stuff. But when you think about the dollar as a reserve currency, the more money printing there is, the less attractive it becomes to other central banks and things to store their reserves in dollars. And I think that's why we're seeing central banks around the world, and most importantly, Bank of China, Russia, potential areas where we have a geopolitical conflict with these countries in some respect or another. It becomes a no-brainer for them to say, okay, they're rapidly debasing the currency. Why should we have more than is absolutely necessary invested in dollars when we could own things that are going to potentially protect our our purchasing power as a central bank better than dollars would. And you just look at 10-year treasuries yielding 3.25% or something like that, with inflation running well higher than that, and money printing was, M2 is actually in decline now, but M2 was soaring at a rate we hadn't seen literally in decades. So owning treasuries in an environment where they have negative real returns is not an attractive proposition, I think, for a lot of central banks, and dollars being debased rapidly. And so that's why we see record gold purchases by central banks over the past year or so.
Mm-hmm. What do you think could be done to rebuild the confidence in the Fed, or do you think we're really just past the point of no return monetarily, especially when we consider that Powell has now scored the lowest approval rating of any Fed chair since 2002?
Well, this comes back to an important, I think this is the most important discussion to have about the Fed. Ben Bernanke, back also in 2011 or something, he was, maybe 2010, around the time he wrote this article, he was asked when he was testifying in front of Congress, why isn't this, money printing? Why isn't this monetizing the debt, right? Because monetizing the debt is a problem. That's inflationary, right? If you're just going to say, okay, instead of generating the revenue to pay back our bonds, we're just going to print money to pay back bonds. That's inflationary. Well, Ben Bernanke's answer was really interesting. He said, well, this is an emergency measure, right? This is only going to last for a short period of time. And then we are going to normalize the balance sheet. And that's how you'll know this isn't money printing, right? That was more than a decade ago. And instead of normalizing the balance sheet, we've done the opposite, right? So by Ben Bernanke's definition, we have been monetizing the debt, essentially printing enough money. And if you look at the Fed's balance sheet and debt to GDP on the same chart as another chart I've had on the blog a while back, it very closely mirrors what debt to GDP. When debt to GDP is growing, the Fed balance sheet has to grow. We've reached a point where the Fed has to step into the Treasury market, or we'll start to get problems, I think, with supply and demand, which we saw in 2019 with the repo fiasco, which we saw in the early stages of COVID. Just too much volatility in treasuries. And I think we'll probably see again, if we go into recession and the deficit's already blowing out, Treasury needs to sell a bunch of debt, they might have to, pay a much higher interest rates to get that done in a total market, free market environment. Now, we couldn't obviously handle that in recession. We need lower interest rates in recession. So the Fed might have to step back in again and start monetizing the debt again. But I think that's the way my friend John Hussman put out a really important piece this month, where he showed, what Paul Volcker achieved was he restored confidence in people's faith in the central bank's willingness and its dedication to restore monetary sanity, right? And essentially in normalizing the balance sheet. That's what Paul Volcker did. So I'm doing whatever it takes to normalize the Fed's balance sheet. Now, we've seen the opposite with Jay Powell, right? Where they've started the process of quantitative tightening. It's been going for about a year. But as soon as we saw Silicon Valley Bank get into trouble, Fed just opened the floodgates, expanded the balance sheet again. Mm-hmm. And so I think that's a clear sign that this Fed is not willing to do whatever it takes to restore confidence in monetary sanity. And so that opens the door to a bigger inflation problem down the road. But I think it's really important that people need to look at the balance sheet. Is the Fed going to normalize the balance sheet, right? Are we going to take it back to some normal level, like pre-GFC level relative to GDP and things? That's the only way I think we're going to restore confidence in the Fed. If the Fed's not able to normalize the balance sheet, then we're in a different world. We're in a different world where debt monetization is necessary, and that's inflationary in a larger secular sense.
Mm-hmm. Jesse, do you think that, with the Fed and the Treasury really stepping in to save SVB, I can't remember if it was considered a systemically important bank or not, but does that really just set the precedent for, the Fed to just come in and save the day no matter what the institution is, really?
Well, it's really the FDIC. The way I read it is they basically, without putting it into law, they've basically said we are going to guarantee all deposits in the country. And, the FDIC supposedly is going to do this by charging the other surviving banks, greater fees in order to kind of cover the losses at these other banks. Now, there's all kinds of problems with moral hazard, I think, with guaranteeing all deposits. Basically, you're telling bankers, take all the risks you want. If it works out, you keep the upside. If it doesn't, FDIC is going to come in and rescue you. And like Silicon Valley, bank guys made tons of money over the last, 3, 4, 5, 10 years, and they get to keep all that money. And so it skews the risk reward equation for all these executives to take more risk and actually to put the banks, at risk of failure in order to generate as much profit as possible. And it's just it's probably not a smart way to run. I mean, Warren Buffett, said this the weekend before last, that, those types of incentives are not very wise to allow, your economy to run by, because it encourages too much risk taking and not enough personal accountability. Mm-hmm. That becomes a problem for the federal government, who ends up having to bear the costs, and the U.S. taxpayer.
And maybe not even, just looking at it from a risk standpoint, but even, forcing yourself to really take the time to try to understand the market and understand risk. Maybe that's another part of it too.
Absolutely. I think, it's healthy to, you think about the people who have deposits at banks that are above the FDIC limit of $250,000. Mm-hmm. You think they'd have, potentially the intelligence and the incentive to research these banks and see, okay, how likely are they to, default or go out of business, and I'm going to lose that, that money that's above and beyond 250,000. Mm-hmm. The fact that we're essentially bailing out people, that have more than $250,000 deposited at one institution is kind of silly, I think. I mean, you looked at Silicon Valley Bank in particular, you had all these startups that were funded by VCs who had ungodly amounts of money investing in these companies. And I'm not saying that, that I want these companies to startups to fail and not be able to pay their employees and these types of things. That's not the case at all. But if you are a CFO at a startup and you've got $5 million in the bank to make payroll and whatever, you sure as hell better be able to determine whether that bank is safe to deposit that $5 million at. And as a CFO, that should be like one of your most basic duties for the company. So to bail out these kinds of startups, I think is ridiculous. Just my 2 cents.
Again, that kind of takes away the moral hazard and that self-limiting tool, kind of taking away the actual utility of free markets and who gets rewarded by the free markets to do business in the correct and most, let's say, I don't want to say upstanding way in a moral way, but the way that things need to run to be able to
Right. Yeah,
correct
if you
and limit
allowed
themselves.
if you allowed more of a free market type of system,
Mhm.
you'd find money flowing to the banks that are the best run, best managed,
Mhm.
and that's the whole purpose of capitalism, right? Is for the money should flow to its most useful, most effective purpose, and so as soon as you start messing with that and implementing bailouts and these types of things, money doesn't flow to the most effective use or the most efficient use. It flows to the most convenient or the most attractive in terms of short term. People don't have to worry about risk and say, okay, great. I mean, they're offered 6% CDs. I'm going to put my money there and not worry about whether they can pay it or not, because the federal government's going to make sure I get my money back. And so you get misallocations of capital, which cause all these other problems.
So Jesse, now that we're at 5.25% and we've run off the balance sheet, or we had run off the balance sheet somewhat, does the Fed now have the tools to fight the next financial crisis, considering that they have room to back off on interest rates and maybe go back to some type of QE expansionary program? Or has the marginal utility of these tools really grown stale and will require bigger and bigger moves to gain that same outcome?
I think that is the question to ask about monetary policy. I personally think we've entered a new era of monetary policy. The QE era is over, because quantitative easing was a discretionary policy. Fed said we are going to print money in order to boost the economy. The Fed can no longer get away with that, right? If you're in a discretionary way, like we did during the pandemic, what we're seeing now is if you print money in a discretionary way, it results in inflation. And we already have an inflation problem. So if the Fed just decided to reverse course now, economy's too weak, we're going to go print money again, you'd probably see inflation go back up to 8%, 9%, 10%, something like that pretty quickly. And part of that would be the psychological part of it, of people saying we've completely lost faith in the Fed's willingness to do what it takes to rein in inflation. But part of it would also just be that we've reached the point where the growth in the money supply has just become directly inflationary, because it's monetizing a fiscal deficit, right? A fiscal deficit of 6, 7, 8%. You monetize that, you're going to get inflation. If the deficit, was a lot lower than that, and there was a little bit more monetary restraint or fiscal restraint, the Fed probably would be able to do a little bit more. And that's why I think the Fed was able to do this in 2010, 11, 12. You had the Tea Party in Congress saying, we're not going to approve any new spending. And you had actually a lot of fiscal restraint. I'm not crediting the Tea Party with anything, preventing inflation or anything like that. It's just a fact that fiscal authorities weren't doing very much in the early days post GFC. That allowed the Fed to do a fair amount without creating inflation. But now that we have these massive and growing fiscal deficits, anything the Fed does to monetize those is potentially significantly inflationary. So I think we're in a new era where the Fed is going to be forced to be much tighter. They're going to have to keep, this is what Jay Powell said, we're going to have to keep interest rates higher for longer. We probably have to keep them here at 5% for a prolonged period of time to see inflation come back anywhere near target. And they're going to have to keep doing quantitative tightening until the Treasury market breaks, which is another interesting thing we could talk about, because Bill Dudley, former head of the New York Fed, has said several times so far this year, he'd be surprised if we don't see turbulence in the Treasury market, right? To me, that says you see interest rates going up when they shouldn't be, right? We have a weak economy, but rates are going up. That's kind of a scenario that I've been on the lookout for. And I think as we get closer to this debt ceiling debate and things, or debt ceiling deadline, we need to keep an eye on this, because if we are headed, I do think we're headed for a hard landing, in the second half of this year. that should mean interest rates come down. If they haven't been able to come down, right? Copper to gold ratio, things like this suggest rates should be coming down. They're not. They're actually going the opposite direction last few days. That's a sign to me that there's something bigger going on. We're starting to see potentially this turbulence in treasuries, and it's something to just, I think, be aware of.
So, using that term turbulence in treasuries, what could happen once we see that the debt ceiling debate, be resolved? Could that, end up being what the markets need, or is that the source of the turbulence?
Well, obviously, if we don't get a resolution to the debt ceiling, markets are expecting that we will. So, there would be some significant repricing in assets if there were any hint that there's not going to get a deal is not going to get done, and we're going to have to even have a prioritization of payments or something like that. It's a problem, a real problem, and that could alone create significant volatility in stocks and bonds. But I think maybe what people don't appreciate enough is, okay, let's imagine we get a debt ceiling resolution. It's probably the most likely outcome. Treasury says, okay, now the Treasury is broke. We need to refill the Treasury. We need probably, at least a few $100 billion in the Treasury, if not getting back close to like $1 trillion in just cash at the Treasury to kind of meet obligations and all these things, make payments. So refilling the Treasury's coffers means a significant issuance of new Treasuries at the same time as the deficit is blowing out. And so there's going to be a significant amount of new supply coming on in the Treasury market this year, even after the debt ceiling is resolved, we assume. That is potentially a negative shock to liquidity, right? If the Treasury is going to just now soak up tons of liquidity with all this new issuance of Treasuries, that's potentially bad news for bonds. I mean, right, that if you have a bunch of new supply coming on and there's not a bunch of demand for Treasuries yielding 3.25% with inflation well above that, interest rates might have to tick up. Like I'm saying, the interest rate, you may go back to 3.5%, close to 4% on the 10-year Treasury. If the economy is headed towards a hard landing at the same time as you're getting jacked up interest rates, that's problematic. But at the same time, that sucking of liquidity, right? One of the things that's benefited the stock market over the past 9 months is that the Treasury has gone from significant amount of assets to zero. They've basically just run down all the assets in the Treasury general account. Now, that's allowed liquidity to be better than it otherwise would have in the markets, right? That we're selling less, we're sucking less liquidity out of the markets. Now that once the debt ceiling is resolved, let's imagine, in the next week or two, and Treasury says, okay, great, you raise the debt ceiling, we're going to go sell a bunch of bonds. That could potentially reverse that liquidity trend that we've seen in place for 9 months, to where you would get a natural rolling over in stock prices and potentially bonds as well.
Yeah. Jesse, as we've seen some of those regional bank failures, I think the broader market has held up better to this point than most in this field expected. And I think your point about the liquidity helps make that point and maybe reinforce that mechanism of why and how that has happened. So do you think it's possible for the Fed to keep being hawkish to try to regain some of that confidence that we've talked about by squashing inflation, or is the true destruction of this ticking time bomb of the lag effects of the rate hikes still burning away in the background? In other words, are we still yet to see the destruction of those rate hikes and get that hard landing that you were just talking about?
Yeah, it famously, monetary policy famously works with a lag, right? All of these leading indicators work with a lag. I mean, one that I look at very closely is, just a composite of the dollar, interest rates, and oil prices. And this has about a 2-year lead for GDP and corporate earnings, right? So when these things go up a lot, oil prices, the dollar, interest rates, you usually see 2 years later, real weakness in the economy and corporate earnings. And so what did we see in 2021? We saw oil prices rip higher. We saw the dollar rip higher. We saw interest rates rip higher. So that points to, kind of a second half this year, first half next year, pretty, dire outcome for corporate earnings and the economy. Now, interest rates kind of work with the same. I mean, and interest rates are one of those components that I'm looking at. But when you have all of them working together, they're pretty clear as to what to expect going forward. So, the Fed's interest rates, right? We've seen those long-term interest rates have been going up for 2 years now. Fed's interest rates only has about 12 months of, it's been 12 months. They've gone from 0 to 5%. So, that has probably at least a 12-month lag effect there. So, that would say, by first half of next year, we would probably be really seeing the true effects of, the rate hikes we've seen so far. So, yeah, it works with a lag. We see it in the leading indicators. Versus any leading indicator you want to point to, yield curve, all kinds of things are suggesting there's a hard landing coming. Because it hasn't happened yet, people think it might not happen, but that's just not appreciating the fact that these things do work with a lag. It takes time for interest rates to work their way through the system and all that kind of stuff.
So maybe just to, I guess, make it more explicit, we've talked about inflation, we've talked about all these things. When we combine the ideas of the growing deficit spending and growth of the money supply relative to GDP, and then adding in the unfunded public liabilities to this equation, does this end up being, an extremely bearish setup for the value of the dollar going forward, comparing it to these other currencies?
I think so. I think when you look at just the dollar, right, the best read on the dollar that I've found is the deficit, right? You look at we had a very significant dollar strength in the 1990s that peaked in around, I think, 2001, 2, around the time we had a fiscal surplus in 99, 2000. That rolled over with that recession of the dot-com bust, 2001, 2002. We went back into deficits, and it widened all the way until the great financial crisis, where you had peak negative fiscal, which is, peak deficits. And the dollar followed that trajectory, right? Dollar peaked in that 2001, 2002 timeframe, rolled over, bottomed around sometime around the great financial crisis. Coming out of the crisis, economy recovered. We had actually a fair amount of fiscal discipline in those early 2010s, 11 timeframe, and the deficit narrowed significantly. Dollar rallied hard, and even this again coming out of COVID, we had a narrowing deficit. Dollar rallied hard as the Fed was raising interest rates and things. But the dollar with the deficit, Stan Druckenmiller just gave the commencement speech at USC Business School, and he said, "Never in history have we seen a worse fiscal outcome from an economic expansion than we've seen now," right? The deficit, the economy has recovered dramatically coming out of the pandemic. We had an opportunity to really improve our fiscal standing, but we only got back to like a 5% still deficit of GDP. We didn't get back to 1% or 2% of GDP. We've still at 5% wide, and now we're headed back down to 6-7%. And so this is the worst fiscal outcome during an economic expansion that we've seen in the country's history. That should tell you pretty much all you need to know about what's the likely path of the dollar over the next few years.
I guess inherent in that question is the idea that this is, again, a moving measuring stick, right? We have these other currencies in the world relative to the dollar. So how do you see the rest of the world, let's say the euro and the Japanese yen, performing against the dollar, considering, their fiscal and monetary status as well?
Yeah. Well, it was an interesting article in the Financial Times last week that showed the US fiscal position is now worse than every country in Europe except for Greece and Italy. And we're going to pass Italy in the next couple of years, and we'll pass Greece before the end of the decade. So we will have a worse fiscal position then every country that had, the European sovereign debt crisis a decade ago, we're worse than Portugal, we're worse than Spain, and we're going to be worse than Italy in the next couple of years, and we're going to surpass Greece in the next several, before the decade's out. So, to say, well, the Eurozone has its own problems, yes, but they're not as bad as ours. And they don't have, when you look at, it's interesting too, to talk about the debt to GDP level. We're at 100% or something like that, which is the only other time is in World War II, we've even gotten close. But this doesn't include the unfunded, liabilities of Social Security and Medicare and entitlements. When you include those, we don't have, $30 trillion of debt or something. We have about $115 trillion worth of debt. And so to pretend that that's not an issue is extremely myopic. That is the driving issue for why the deficit is blowing out right now. It is, Social Security payments went up 9% this year, right? Inflation adjusted, and more people are going on Social Security every year. If it doesn't get reformed, and there's no impetus on either side of the aisle in Congress to even touch it, right? We saw this Biden State of Union address. Neither Democrats or Republicans will touch it because it's political suicide to talk about reforming entitlements. So it's not going to get touched. So then that means that 100, near 100 trillion of liabilities, present value, is real debt. And so that's what's going on. And until people actually start facing those facts head on, I think it's really tough to talk about being bullish on the dollar when that issue is becoming a present day problem with the deficit blowing out the way that it is.
Yeah, I mean, sitting back and looking at that situation from an incentive perspective, there's no way that those incentives align to do the right thing or even start talking about doing the right thing. The
only way it's going to happen, I think, is if we do get some type of a crisis in the debt market. Mm-hmm. We start getting this turbulence in treasuries that Bill Dudley's talking about, where you start seeing rates go up when they shouldn't, right? When you start seeing 10-year treasury interest rate 30 years go up, maybe up above 4% or something, even as the economy is going into recession, that's going to be a very clear signal to Congress that there's just supply demand problems in the market. People don't want to buy, negative real yields on treasuries at a time when the deficit's blowing out, and we're going to have to print money to pay back pay back the principal on those treasuries and pay interest on the treasuries. That's a clear sign that we're going to have to start looking at these issues. But I hope we don't get there, but I think that's probably what's going to have to happen in order to get people to recognize we have to deal with these issues.
Mm-hmm. But at that point, does the Fed not step in and start buying all of those treasuries and basically explicitly start yield curve control?
Absolutely. The Fed's going to have to do that. I mean, if you do get that type of an issue in the treasury market, the Fed will have to step in and do yield curve control in order to prevent a bigger disaster. I mean, imagine if we go into recession and interest rates do go up, mm-hmm. right? It's just, that hasn't happened, before. And it would actually potentially make the downturn much more severe than it would be if interest rates came down and kind of softened the landing to some extent. But if the Fed reverses course and implements yield curve control, what does that do to the psychology towards the Fed? We already have the lowest approval rating in the history of the central bank, according to Gallup. People would lose confidence in the Fed's willingness to rein in inflation. And if we lose confidence in the Fed's willingness to lose inflation, then you get that psychological tipping point into people going, okay, I know that my grocery bill is going to be higher next year. I know that all these things are going to be more expensive next year. It creates an inflationary psychology for people to go spend more today, which can exacerbate the inflation problem we're already dealing with. Mm-hmm. And so we're a lot of these things, sound scary, but I think that we are nearing that point with inflation where the Fed has to stay the course But if they do stay the course, it potentially creates a very painful downturn for the economy. And so they're going to have to choose between coming to the rescue of the economy or allowing inflation allowing inflation to get out of control, or sitting on the sidelines and allowing the economy and the bond market to just tank. And I can't imagine Jay Powell doing that. He's already showed us with Silicon Valley Bank, if we need to expand the balance sheet in order to prevent a deep downturn in the economy, we're going to do that. And so I think it's pretty safe to assume that when push comes to shove, the Fed's going to back down and inflation is going to probably become an even bigger problem. That might be what it takes for Congress to get their act together and say, we have to start dealing with the fiscal issue.
So Jesse, when we combine all those ideas about inflation, about the deficit blowing out, the value of the dollar, potentially being in a very bearish scenario here, why does gold tend to do well in that type of environment? Is it that recognition, that almost market psychology that you just talked about, where everybody starts recognizing inflation and wanting to do something about it to have something tangible that is, somewhat seemingly protected and outside of this, cracking banking and inflationary system?
Well, the fact is, about gold is that it's really the only asset that's proven itself for thousands of years to be an effective store of value during these types of inflationary episodes. And so that's where the demand comes from. People go, okay, potentially there's the possibility of getting what Austrian economists have called a crack up boom. Mm-hmm. So you get this inflationary psychology and people say, I want to have, I don't want to own currency. I don't want to own dollars. I want to own anything else, anything besides that. And so maybe I want to own real estate. Maybe I want to own collectibles. Maybe I want to own commodities. But the most straightforward answer and obvious answer is precious metals, because they have been an effective store of value in these types of scenarios for long periods of time. And so the investors are dramatically underinvested in precious metals today. So if these things kind of play out in this way, which, like I said, I hope they don't, but there's a chance that they do, investor demand for gold could go through the roof. And technically, from a just pure technician standpoint, that looks like what gold is setting up for. We've seen the gold price take off, when the money printing began in 2020. We hit the 2000 and change level, and we've seen this, essentially parallel consolidation channel since then. And now we're potentially breaking out of the upper end of that technical channel. And you from just classical technical analysis, you'd say the move prior to that consolidation range was about a $700 gain in the gold price. Breaking out above this channel again would project a measured move of about $700 higher in the gold price. What would power gold, to $2,700 an ounce or something like that? It would probably be some type of forced reversal at the Fed, where inflation's not yet under control, but the Fed is having to somehow monetize the debt. And that would probably see gold go pretty quickly, I think, to 2,700.
Mm-hmm. Jesse, how else would one think about achieving, protection against inflation that we've talked about that seems to be inevitable? We've talked about a lot about the energy trade and the need for energy in the world today, but going into any type of a hard landing, this seems to really cut demand for that. So, how do you see those forces balancing out there?
Well, that's a good question, because you look at things like commodities to M2 ratio. We started out the conversation looking at household net worth to M2. The economy to M2 and these types of things. If you look at the value of all commodities relative to M2, look at the oil price to M2, they're about as cheap as they've ever been. And so this is why I think the Saudis are, saying we're going to cut production and things, because the oil price in real terms, right, is very, very cheap. If you think about when was the last time we saw oil prices spike over $100 a barrel like they did in 2021, 2020, early 2022? It was back in 2008, right? So essentially the oil, and we still didn't even hit those highs that we saw in 2008. So since 2008, for 15 years, oil prices have been declining, even as money printing has been growing and the real value. So the real value of oil is down even more dramatically. So at the same time, you have production declines. You have the Saudis saying, we're going to protect the oil price at $70 a barrel. We don't want it to go below that. And you have US producers in shale essentially saying, we can't produce more, right? You had the oil price go over $100 a barrel, and they didn't produce like crazy, like you might have expected them to. In fact, we're seeing the number of rigs in operation, all these things roll over. Production is actually probably going to go into decline here in the United States, along with, what Saudis are doing. And so if you have, falling production at the same time, and not to mention supplies with the release of the SPR, if you include that, supplies are now back to where they were like in the late 1990s, US oil supplies, right? So we have very little in supply. Demand continues to grow. I think for the oil price, definitely over the next several years, the path is significantly higher. I think we're, short answer is, I think we're in a commodity super cycle. Supply and demand validates that over a longer period of time. In the short run, yes, things like copper and oil are worried about demand if we go into a hard landing. But then again, it just depends on how we handle those things. If the Fed handles those in an inflationary way with money printing again, I don't think there's going to be much downside for oil prices or copper, things like that.
So, positioning wise, Jesse, obviously not speaking directly to your book, but looking at the situation that we're facing, where we are right now with this hard landing, very potentially coming within the next quarter or so, the debt ceiling debate, there's just so many moving parts that it takes, 45 minutes to an hour to be able to cover properly. How do you position yourself from, a defensive standpoint? Are you trying to be in cash for when that shoe drops? Are you being defensive by, holding some short-term treasuries? Where do you see the defensive posture that it seems like most people should be adopting at this point?
Well, I always think it pays to be diversified and not bet too big on any one thing, unless you have a really high confidence fat pitch kind of thing, and you're using very clear risk management to do so. But generally, for the average investor, it doesn't hurt to be in cash right now when you can get 5% plus, short-term interest rates, and have some dry powder to take advantage of opportunities. I think, you have to have a minimum amount invested in precious metals, just as insurance, right? I mean, like I said, I hope that I'm wrong and we don't. And I hope Bill Dudley's wrong, and I hope that Stan Druckenmiller's wrong, and all these people, and even Warren Buffett, in his annual letter this year, gave a very clear inflation warning. You have all these, smart people kind of pointing to this outcome. I hope that they're all wrong, but if they're not, you have to have a minimum amount allocated to precious metals. I think minimum is probably 10%, but up to 25, 10 to 25 is probably an appropriate range for precious metals. Have some cash, some dry powder that's earning 5%. That's roughly in line with CPI today. So that's that doesn't hurt you. I think we're potentially people might have issues is. I don't think you want to be too heavy into treasuries. I mean, they might work if we go into a hard landing. Longer term treasuries could work. They typically have in the past. They could also go the other direction because of these supply demand dynamics. And I think if you have too much invested in the U.S. equity indexes, right, these big tech stocks still trade, at absurd valuations. If interest rates are going to stay high for any period of time, the valuations on these things have to come down, and they're not growing, right? You look at all of these companies, Meta, Apple, they all had essentially 0% revenue growth, right? And so that's negative in real terms, right? Deflate that by any measure you like, and it's negative growth in real terms. And they're at the same time, their profitability is being hampered by different things. And now with this AI race, they're going to be spending like crazy in order to try and capture this. That also could potentially hurt their profitability over the medium term. And so I think, being overly aggressive in financial assets is probably, problematic. Being underinvested in real assets is also equally as problematic. So I think that's probably something people need to think about.
Yeah, it's a really, I guess, interesting idea that you kind of touched on at the beginning there. All of these people warning about more inflation ahead, not just the inflation that we've already experienced.
Well, it's pretty clear that with the fiscal trajectory, right? Right. I mean, what does that mean, right? We have a 7% deficit every year. That means the Fed has to issue 7% of GDP every year of new debt. That's essentially somebody has to buy that debt, and I don't see how you do that without monetizing it. I think since 2019, it's been pretty clear with the repo fiasco that there isn't the natural demand out there to meet the supply of all these new treasuries. The only way you get them sold is if the Fed is buying a significant amount of them. So I do agree. I think we're probably going to see yield curve control at some point, and that's just to monetize all the new debt issuance. It's in light of that, it's hard to see how we don't see sustained elevated inflation for a prolonged period of time.
Mm-hmm. Well, Jesse, I think that's a pretty good spot to kind of wrap up today's conversation. That kind of put a nice bow in it. Is there anything else that you want to mention before we do?
The only other thing I'd mention, and this is more of just kind of a sociological thing, is that with the rise of AI, we've had so much disinformation and stuff and things in social media. That, I think, trend is also going to continue with AI. And I think there was a great piece I tweeted last week, that Grant Williams first shared. And the point that he makes in this article is we should be less concerned about, what AI is going to do and more concerned with how we as people consume this information. It's really important to ask yourself, okay, why is this thing that I'm reading or whatever or watching making me feel a certain way, and who benefits from me feeling that way? Mm-hmm. In short, recognize when you're being manipulated and be just aware so that you can choose to be manipulated by it and be essentially somebody's pawn in a bigger game of influence, or retain your free will by just recognizing that, hey, it's my choice to react the way they want me to react or not. And I think that would be just a huge thing generally for people to try and wake up and just not be manipulated by the things that we read and see every day.
Well, Jesse, I think that's obviously a much broader discussion, but I think that has applied, even before the age of AI.
Absolutely.
I think that there has been countless examples over the last, especially 3 years, where we could point to and say, well, that was clear disinformation, whether it was intentional or not.
Yeah.
There are gradations of gray there maybe, but it doesn't
even have to be disinformation. Mm-hmm. It can be distraction. It can be okay, the real issues we need to talk about in this country are X, Y, and Z, right? But you have, maybe news outlets and things that are focusing on these other issues that maybe make you very angry about what's going on in the country, but they're of relatively little importance compared to the other issues that we should be talking about and debating as a nation. And so I think it's important to say, okay, am I being, am I having the wool pulled over my eyes, or, some type of a shell game going on to distract me from paying attention to what really matters? So it might not even be disinformation, it could just be distraction. There's so many different ways of manipulation right now, and AI is just going to make them that much more effective.
Mm-hmm. That's a good point, and I think an interesting spot to kind of end on here, Jesse. Of course, for anybody that wants to read more of your stuff, you're available at the felderreport.com. And of course, you mentioned your Twitter at Jesse Felder. Is that the best places to find you?
Yeah, pretty straightforward.
Perfect. Thanks for your time today, Jesse. Appreciated the chat.
Thanks, Tom. Always good to talk with you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.